Assalamu alaikum everyone, and welcome to a very exciting webinar that I'm looking for. I've been looking forward to this for the last, I'd say, 2 weeks or so, because there's lots of webinars and conversations and talks that we do around investing, but often you don't get to see a journey of a startup from an early stage to a later stage to growing. And I think that with the guys to my left and right today, with Primary Finance, we're seeing a really interesting story that is driven by the grassroots of the Muslim community develop. So I'm really excited to dig into what exactly Primary Finance is up to these days. Obviously, for those of you who've been following us for a while, you know that we've been following Primary Finance for a while. We had an early podcast with the team as well, but a lot has changed since then as well. So I'd love to dive into all of that, inshallah, in the next 45 minutes to an hour or so. But first, let me introduce, we've got Sheikh Salman to my right. So Sheikh Salman is a former lawyer, but he repented from that and has found the straight path after that, like myself as well. And Sheikh Salman is the Sharia lead on Primary Finance and also the legal lead. I probably butchered that intro, by the way. So if you guys spot any issues, then just flag. And then Raza is the actuarial and commercial mastermind behind Primary Finance, and has done a lot of the the initial structuring and groundwork behind the company as well. So welcome to both of you.
Thank you very much.
Really excited to dig in. So I guess the first thing I really wanted to find out from you two is what has happened since we last spoke. A lot of water under the bridge. What's happened?
Yeah, so you make it sound like something bad's happened, but no, alhamdulillah, things are going very, very well. A lot has moved on since we last caught up. So I think when we last did our podcast, we were very much still structuring our products. We hadn't started building our tech yet. We hadn't started actually doing business. Now, since the very start of this year, alhamdulillah, we're in a very, very different position. So we've started doing business. Inshallah, we'll finance our 22nd home this month. We've got a bigger team around us now rather than just the founding members. We've built out our bespoke tech platform, and if we've got time, we'll get into the features of that tech as we go along. It's really exciting, the tech that we've built, and we're growing at the moment significantly faster than we expected, actually, and that's primarily driven by your audience. The community supporting us. I think you hit it right on the head when you said this is a grassroots institution. We say it repeatedly that this is an initiative by the community for the community, and it's the community supporting us and helping us to drive this thing forward that's allowed us to achieve what we've achieved and allow us to grow at the rate that we're growing at the moment, mashallah.
Alhamdulillah. Sheikh Salman, anything to add from your side?
Yes, we've had a tremendous amount of support from the community. A lot of people, our growth has been totally organic. We've hardly had a marketing budget. In fact, it's sort of minuscule. So everything that's happened has happened through pure organic growth. People referring other people, people coming onto our website. Actually, a lot of them have come through IFG, so we've got a lot to thank you for.
Alhamdulillah, that's great to hear. Guys, I am aware that there might be some matrix-like issues. So I mean, I guess it's apt given that the fourth matrix is coming out, and maybe these guys are part of the matrix. But inshallah, we'll get those sorted. But before we, I guess, before we get that, we'll get that sorted in due course. But one thing that I really wanted to understand is, at heart, when you strip it all away, what's the big problem that Primary Finance is actually, trying to solve here? What is that pain point?
Yeah, so I'll start with that, and then I think Sheikh Salman will have some bits to add as well. So really, when I founded Primary Finance several years ago, so at the time I was working at the Bank of England. I was, in a city job, earning, alhamdulillah, very good money, and I had a sort of, for those of you who have followed our journey, I had a sort of life-changing experience on Hajj, and I just decided that I wanted to do something about the housing market and the difficulty that particularly Muslims find in actually being able to purchase a home in a way that they feel comfortable with, both spiritually and also economically. And so what I found as I started doing my research was that conventional mortgages obviously are based on riba, which from an Islamic perspective is completely impermissible. And then the Islamic bank mortgages, the Islamic banks, have started paving the way for Islamic finance, and they've really laid the groundwork. But there were still, some niggling issues, some differences of opinion. And what I wanted to do was found a product that was completely free of differences of opinion, where it's just clear cut, completely pure as day, no contentious issues whatsoever. And also, one of the other issues I found was, we were finding people found the processing very slow with Islamic products. So, conventional banks have been around for a while, and they've been able to really fine tune their processes and process people very, very quickly. And it seemed that the existing products weren't quite able to match that. And so I wanted to make sure that through a tech-based approach, we were able to actually remove the pain points associated with onboarding and then managing agreements. And so the two key responses to your question are finding a product that everybody is comfortable with, both the strictest Muslim and the strictest atheist. Everybody should be comfortable with it. And also then finding a product that everybody finds easy and comfortable to get to grips with and actually use both from start of the journey right through to the end.
Brilliant. No, that sounds great. And Sheikh Salman, anything to add from your side?
Yes, over the years, I've had various conversations with the Sharia scholars who sit on the various Sharia boards of Islamic banks, both in this country and around the world. And almost unanimously, they say that there's a lot that can be improved with the current Islamic finance market and the products and the Sharia compliance. And there's an acknowledgement that the next generation, our generation, we have the skill set, we have the momentum to make those improvements. And really, we see ourselves as the next generation of Islamic finance that's built from the ground up based on pure Sharia based, if you like. There's a distinction between Sharia compliant and Sharia based. So we see ourselves as the next generation moving from sort of Sharia compliance and just ticking the boxes, but to going into Sharia based products, inshallah.
Yeah, and that's why actually our product, we built it from the ground up. So rather than trying to take an existing product like a conventional bank mortgage or even an Islamic bank mortgage and trying to adapt that, we effectively just started with a blank sheet of paper. I mean, I was sat away at my desk for 6 months after I quit my role at the Bank of England, sat away at my desk for 6 months researching and structuring and just starting with a complete blank sheet of paper in order to try and come up with this completely radically different approach.
And did you know when you were going to quit that you were going to do something in this space, or was it literally a blank piece of paper?
Yeah, so the whole reason I quit, I basically went on Hajj, and I had a life-changing experience on Hajj, and I remember standing on Arafah, hands raised to the sky, saying, "Ya Allah, you've given me everything. You've given me health, wealth, iman. You've given me an actuarial skill set that not that many people possess, an able body, an able mind. So, Ya Allah, what am I going to say to you when you ask me what I did with it all?" And the thought of that terrified me, and I cried my eyes out on that day in a way I can never ever forget. And that was the point at which I decided, right, I've got a skill set, I need to do something with it. And, I could go into the charity sector or something, but there's, alhamdulillah, loads of people doing really good work in that sector. Whereas the Islamic finance sector is, certainly at that time and even now, was still very much maturing and developing. And I just felt that was a sector which I could really apply my skill set to. And I decided I want to particularly focus on Islamic home finance. And so I quit my job with the intention of actually setting up primary finance from that point.
Alhamdulillah, that's great to hear. And how, I guess, this is going slightly off piste, but how have you guys found this whole, the switch from the corporate and, doing that kind of city life to, doing your own thing and I guess working in Islamic finance and fintech? What's it been like, I guess, personally, but also from a culture perspective as well, switching from one to another?
Well, I don't have as much money as I used to, that's for sure. But alhamdulillah, I would, I've never looked back. It was a scary, scary thing to do, giving up my job, particularly because, alhamdulillah, I was in a very senior role, earning very good money, very comfortable. So it was a very, very scary thing to do. But I knew why I was doing it, and I would do it again every single time. And coming from an actuary, by the way, for those who know what an actuary is, actuaries are the most risk-averse people on earth. So for me, it's scary enough quitting your job if you're a risk taker, but for me, it was literally the scariest thing I could possibly do. But alhamdulillah, the corporate culture has its pros and cons. As anyone who works in the city knows, particularly as a religious Muslim, there can be pressures which working in mixed environments and pressures to socialize in a way you don't necessarily want to socialize. Whereas working in the entrepreneurial environment in a very Islamic organization where we can dictate how we socialize and we can dictate how we operate and what our ethos is. I personally really, really enjoy that. And the entrepreneurial lifestyle, as you know, is very heavily encouraged in Islam as well, because you can do so much good by, applying your skill set to a problem that hasn't been solved yet.
Absolutely. Completely echo that. I really wanted to get into the actual nuts and bolts of primary finance. And by the way, for those of you who are just joining us, this is a webinar where we're discussing an alternative to Islamic mortgages. We're going to be diving deep into primary finance, which is a Sharia-compliant alternative to an Islamic mortgage, and really trying to understand what exactly that product is and how it works. I'm also very pleased to announce that we fought off Mr. Smith from the Matrix, and I believe now you can actually see us without any of the green stuff going on. So there we are. I think it was the power of dua. Maybe someone made dua somewhere, and it must have hit home. Great. So what is the primary finance solution in a nutshell? What actually is it?
Yeah, so I think the first thing I would say is forget everything you know about a mortgage, because it's not a mortgage. A mortgage is where you borrow money from a bank, you go away, you buy your property, and you now owe that money back to the bank with interest over a set period of time. That's not what this is. This is completely different, radically different from a mortgage. The easiest way to think of our product, Ibrahim, is imagine you're renting a property from a landlord, right? So your agreement with your landlord is to pay rent every month. As long as you're paying your rent to your landlord every month and taking reasonable care over the property, you are completely fulfilling your obligations to your landlord. You have no other obligations whatsoever to your landlord. Now, imagine if your landlord came to you and said, Ibrahim, you're a good tenant. Just so you know, if you ever wanted to purchase the property from me, I would sell it to you. And you don't have to if you don't want to. Completely optional, no pressure. But if you wanted to sell it, just so you know, I would sell it to you. And I would sell it for the same price I bought it. And you can buy it all at once if you like, or you can buy it gradually over time if you like, or you can just continue renting, no pressure whatsoever. In a nutshell, that is our product. It's really as simple as that. So the key differences to that scenario are typically when you're renting from a landlord, you have to rent whatever property the landlord happens to have available. Whereas with our product, you're free to go and choose your property. You find the property you like, and then we go and purchase that property in a partnership arrangement. Usually when you're renting from a landlord, you have a 1-year assured short-hold tenancy, whereas with us, we give you a long lease over the property. So you actually have a lease title, and that may be, for example, 20 years long or whatever it may be. And actually, our policy is, even if the lease expires, our policy is to always renew it if you want to renew it. So you can effectively rent the property for as long as you like if you want to. If that's what you want to do, if you just want to rent, you can effectively stay there renting for as long as you like. As long as you're not breaking the terms of the lease, you can stay there pretty much indefinitely. And then the way it works is, rather than us buying the property 100%, we effectively both contribute to the property as partners. So let's say you've contributed 50% and we've contributed 50%. So the amount you've contributed dictates your partnership share in the property.
Right.
So rather than you having to rent the entire property off of us, 100% of the property, you just rent the remaining 50% off of us, right? So to put some sort of figures into perspective, let's say it's a £100,000 property. And let's say you've put in £50,000 towards it, and we've put in £50,000 towards it. And let's say that property would normally rent for £1,000 per month on the open rental market. So because you've put in 50%, your partnership share is 50%. So rather than your rent being £1,000 per month, it will be £500 per month. Now, if you say to us that you want to fully own your home after 20 years or 30 years or whatever it may be, we'll say to you, right, well, in order to achieve that, you need to gradually or all at once, if you like, increase your partnership share. And so we'll go away and we'll do a calculation for you. We'll say, right, in order to achieve your 20-year target, here's how much equity you need to purchase every month, so that after 20 years, you've purchased up to 100%. Now, this is just a calculation to help you focus on your objective. You can ignore it if you like. You can go higher than it. You can go lower than it. You can ignore it completely. But it's to help you focus on your objective. And whenever you stick to that target level of equity purchase, because we want you to achieve your objective, we want you, one of our main goals is to increase home ownership, particularly amongst Muslims, and increase wealth, particularly amongst Muslims. We want to incentivize you to stick to your target. And so whenever you stick to that target level of equity purchase, we then give you a further rental discount in those months. And you can choose from month to month what you do. But whenever you stick to that level, we give you a further rental discount to make your rent very, very cheap in that month, so that you can actually then buy equity and in a very affordable way. So in the example I gave, let's say your rent is £500 based on your partnership share. And let's say we tell you, right, to achieve your 20-year goal or 30-year goal, you need to purchase £250 of equity every month. And by purchasing £250 of equity every month, after 20 years, you've bought 100% of the equity. Now, whenever you stick to that target, we'll then give you a further rental discount in that month. And the rental discounts are very hefty. They can be as high as 50% in some cases. They're typically at least 20 to 30%. So in that month, rather than charging you £500 rent, let's say it's a 30% discount, we'll only charge you £350 rent in that month. So that means your total outlay in that month is £250 of equity purchase plus £350 of heavily discounted rent, which totals to £600. So you can just pay rent, £500, which is the market rent, the fair price to pay for simply renting a property, or you can pay a little bit more. And when you pay a little bit more, you get a hefty rental discount, and you are able to actually increase your partnership share and gradually work towards complete home ownership. And with our product, you can go all the way up to 100%, and you can go at your own pace. So there's no early or late repayment fees or anything like that. You can even pay it off all at once if you like. It's entirely flexible.
Amazing. And I guess one question I had was, would you explain, how do you guys make money? Because that's important for people to understand. And also, how does the price of the property vary? Is it like, are they buying it back at market price, or how do you think about that?
Yeah, so the way we make money is off of the rental income, effectively. So our business model is built around the rent that we generate from each of our agreements with each of our customers. Now, the price we sell equity at to our customers is original cost. So the way it works is you effectively build up a fund, right? So rather than you actually buying bits of the property every month, what we do is we let you build up your fund, and as your fund builds up, we use that to offset the rent that we're charging you, and that dictates your partnership share in all aspects of the agreement. And then once you've saved up enough, you effectively buy the property off of us all at once. Now, let's say we bought the property, let's say it was a 100K property, and we bought it for 100K plus 5K of stamp duty, so 105K in total. In 30 years' time, that property may be worth £500,000. So assume 5% per annum property price inflation, so it might be worth £500,000. At that point, you've built up your fund of £105,000, and you now offer to buy the property for £105,000. We'll sell it to you for £105,000. So even though it's worth £500,000 by that point, if you offer to buy it from us, we'll sell it to you for £105,000. That's our policy. We'll always sell it to you at cost price. And the reason we've done that, as you'll be aware, most other shared ownership providers will sell at market price or something very near approaching market price. The reason we've stuck to cost price is because, property prices in this country, as you're well aware, increase typically 5 to 10% per annum consistently, whereas salaries only increase 1 to 2% per annum if you're lucky. And so if we were selling at market price, it would become very unaffordable very quickly for all of our customers. And so we decided that our vision of increasing home ownership is more important than that extra bit of profit that we could potentially make by charging market rate. And so we effectively gift all of that upside to our customers in order to make it affordable. And that's how actually what we've done is quite remarkable when it comes to pricing, because we are able to actually offer a shared ownership product at a very similar price point to an Islamic bank mortgage, which, if you know anything about shared ownership products, that's unheard of. Shared ownership products always cost a lot more because you pay total full market rent and you pay market price when purchasing equity with most shared ownership products. Whereas with us, you get heavily discounted market rent, and you pay cost price when purchasing equity.
Yeah, great. So let's now dive a little bit into. So I want to go through, I guess, some questions or objections people might have. And given that we're already talking about pricing, maybe it's a good time to touch on the pricing side of things. How do you approach pricing? Is it market rate rent? And are there any other pricing, kind of concerns or any other things that people have to pay when they go through, the transaction?
Yeah. So look, we are really clear that we want this to be a genuine market transaction, right? And so what we don't do is peg our pricing to interest rates or anything like that. And there's difference of opinion on whether that's okay or not. Actually, there's probably nothing wrong with that when you get down to it. But actually, the point we're making is, why do we need to peg to interest rates? It's nothing to do with our product. So what we do is we start with the market rental rate for your property, right? That's our starting point. We then scale that down according to your partnership share, and then we then knock off a hefty rental discount whenever you're making your target level of equity purchase. And that's how we make it very, very affordable. So we start with the true market price. Now, we do have considerations when it comes to determining what the market rent is. There's no right answer when it comes to market rent. Different landlords will charge different amounts. So we look at the available market information and we try and come up with an idea. We also clearly, as a business, have an internal profit rate that we need to try and achieve. And on every transaction, our aim is to try and marry those two up as closely as possible. But that is our starting point, the true market rent.
Understood. And do you think that you will, as you scale, things naturally get a bit more complicated? How have you thought about that? I mean, I guess you're an actuary, right? So you project years in advance. How have you thought about, increasing cost bases and that sort of thing? Maybe you might have to deal with regulation and various other bits and bobs. Does that change the economics at all? I guess the perspective I'm coming from is the skeptical homeowner, right?
Mm-hmm.
Because that's probably the best perspective to ask you questions on this webinar.
So you're asking, will the price we're charging somebody suddenly shoot up at some point?
I'm asking that, and I'm also trying to work out that okay, so you make your money from the rent, and then you're also offering a discount on top of that rent. I'm just keen for you guys to kind of make profit.
Of course.
So
yeah. So you're not the
my
first
house
person.
is not the
No, you're not the first person who's asked us that. And the truth is, the way we are able to offer that rental discount is, if you imagine when a landlord charges you rent, full market rent, they then have to spend a share of that, paying for the upkeep and maintenance of the property, and things that go wrong. Now, the way we've created our model is, this comes into your question: how do we deal with scale? If we were dealing with the maintenance of every single property directly, it would be a huge cost burden. So what we do is we give that rental discount to our customers, and that rental discount that we give, both on the rent and on the market price of the actual property, that is effectively us saying, look, we'll pay you this share of our profit, which we would have spent on upkeeping and maintaining the property anyway. We'll just pay it to you. And that's you can think of that like us paying you a service fee to do that instead. So we cover our share of those costs by paying you a flat fee. And actually what you'll find is, for the overwhelming majority, probably 99.9% of people, those two discounts will way more than cover our share of any costs. And actually the rest is a gift to them.
Brilliant. Okay, so I guess there's I know there's a lot of questions, and anyone who's asking questions, then please do keep them coming. We will have an extensive Q&A session. And for those who are joining, this is a webinar on alternatives to Islamic mortgages, and we're talking to the primary finance team, Raza on my left and Sheikh Salman on my right. So perhaps Sheikh,
I think on the pricing point, it's worth mentioning that we do have an annual review of the rent. But that's capped at a certain percentage. So, and then when we give our customers an illustration of what they can expect to pay over 20, 30 years, we assume that the rent is increased by the maximum each year. So they have a lot of visibility of what they're expecting to pay over 20, 30 years. Whereas if you think about a traditional mortgage, even an Islamic bank mortgage, they'll just quote you the interest rate now. But in 10 years' time, if the interest rate's 10%, if it shoots up, then it's unpredictable what people will be paying. So we think our product is a much more secure, peace of mind product than the traditional mortgage, which is actually very, very unpredictable.
It's a really good point, because when you get an illustration from a conventional bank, the illustration for what you'll pay over the lifetime of your agreement is on the assumption that interest rates never change. And over 30 years, that's obviously a very unrealistic assumption. Whereas what we do is we give you the worst case scenario. We say, right, if your rents go up by the maximum amount in every single future year, here's the maximum amount you will end up paying over the lifetime of your agreement. And what that does is it completely eliminates gharar, or uncertainty, in the agreement. So you know that you will never pay, as long as you're paying your target amount every month, you will never pay more than the amount that we quote to you, but you may very well, and almost certainly will, in fact, end up paying less than that. So we give complete certainty to our customers when it comes to cost.
Makes sense. One question I had was, I know someone's asking this as well, Jafar is asking, how exactly is primary finance's offering different to an Islamic mortgage? And I guess, it'd be great, maybe Sheikh Salman, you can answer from a legal perspective what the difference is, from a regulatory perspective, what the situation is, and also maybe then, from a pricing perspective as well, like both, in the short term, what a person is going to be paying, but also long term, how that looks as well. Sorry, I know there's a bunch of questions I've chucked at you there.
Yeah. So I think the key difference between our product and Islamic bank mortgages, Islamic bank mortgages were actually designed, and I was a lawyer working in a big law firm advising many of these banks. So for all my sins, I've actually helped draft some of these contracts. So like we've popped the bonnet. We know how the engine works. So the way the engine works in Islamic bank mortgages, it's effectively reverse engineered from a conventional interest-based mortgage. So they look at the economic outcome of an interest-based mortgage, and they see how can we achieve almost exactly that same outcome using a different structure. And the structure they've chosen is obviously the musharaka, or the shared ownership structure. But there's a key sort of tweak they've done to the shared ownership structure, which is they require the customer to buy the bank's share. So if the bank puts in £100,000 into the property on day one, the bank then gets the customer to sign an agreement that the customer will buy the bank's share of the property for exactly that amount, £100,000, which effectively crystallizes a debt. So the customer owes the bank that money. And the way you can tell that is regardless of what happens to the house. So in the extreme scenario, if the house is destroyed and for some reason the insurance doesn't pay out, there's a clause usually in those contracts that says, despite the house not existing anymore, the customer must buy the bank's share of whatever remains of that £100,000. If they've repaid 50,000 and 50,000 is left, they have to buy an empty plot worth nothing for £50,000 off the bank, which means the bank, of course, doesn't share the risk. So I think that's the key difference, and that's the key problem, which is recognized by the Sharia scholars who approve the products. And they've been asking people of our generation, look, we've done what we could in our generation. We built the masjids, we built the madrasas, we built institutions, halal meat. You've got the financial acumen to solve this problem. We've taken the first step by establishing the Islamic finance industry, by establishing Islamic banks. But we need to take and solve those problems and create solutions that enable the Muslim community to become homeowners and afford to do so, but not get into Sharia controversial issues.
Makes sense. And then just picking up on that, on the regulatory and the pricing side of things, what's the distinction? Because I want to get across to the audience how how their experience will differ or not, if let's say they go for Arayan or primary finance.
Just before we get into that,
Yeah,
just
sure.
to sort of add to what Sheikh Salman said. So it's worth just pointing out very explicitly that the key difference with our product is it's managed as an equitable partnership. So if that same scenario did happen, if the property was destroyed and there was no insurance payout, as partners we would suffer that loss together. So a good example I like to give is if you and I buy a car together and we're 50-50 owners of the car and the car is destroyed, as partners we each take a 50-50 loss. Whereas if I said to you, Ibrahim, the car no longer exists, now you need to buy my 50% from me, you'd be livid. You'd say, well, you're insane. Why would I buy this from you? But that's the sort of controversial issue that Sheikh Salman mentioned. And in our product, that doesn't exist. We simply suffer the loss as partners because it's a partnership.
Makes sense. And Sheikh Salman, if I could just pick up on the regulatory side of things.
Yes, so we went through a very long and interesting process with the FCA. And initially, we asked them to be regulated because we don't lend, we don't provide credit, our product is not debt based. We technically don't need to be regulated, but just to make sure that we give confidence to our customers, we wanted to approach the FCA, or we did approach the FCA and asked to be regulated, and we went through a 2-year process with them. And along that way, they told us on 2 occasions unequivocally that because we don't lend and we don't create debt, we don't need to be regulated. And at the end, they actually said that because the FCA is set up to only regulate financial institutions that lend effectively in the banking sector or in the home finance sector, they actually can't regulate us. But they wished us really well, and they said they really like our product and they like the fundamental principles, the Islamic principles behind our product.
Actually, what was amazing with that journey, so we did 2 years of work with the Financial Conduct Authority, and at the end of it, because they wanted to show us a gesture of goodwill, they actually refunded us our application fee after 2 years of work with us, which is actually an incredible gesture from them. But the point is, as Sheikh Salman mentioned, because we're not lending, we're not creating debt, we are effectively a landlord renting out a property. And landlords, as you know, don't come under the scope of financial services regulation. It's just a simple rental agreement. We aren't forcing you to buy our share from us. And you, as I said, you can rent for the rest of your life if you like. If you want to buy our share from us, just like with a landlord, you can offer to buy our share and our policies will always sell it to you. But there is no debt there. And that's why it doesn't come within the scope of financial services regulation.
Makes sense. And one other question that people might have is, okay, this all sounds great, but if you are a landlord, bad times can happen. So what happens in that situation, and how does primary finance propose to deal with it? Let's say, God forbid, you guys, run into trouble, as whatever happens, another COVID hits or something. How is primary finance going to deal with the bad times?
Yeah, so first of all, I think bad times can come from both sides of the equation. So let's say our customer faces difficulty, and let's say we face difficulty, and it's worth covering both of those scenarios. So let's say our customer faces difficulty and they can't afford to make their target monthly payment anymore. So with a bank mortgage, or indeed an Islamic bank mortgage, the customer must pay, let's say, £1,000 every month, consisting, let's say, £500 equity and £500 rent, or capital and interest on a conventional mortgage. So if the customer can't afford to pay £1,000 on the nose, they're in default, and the bank may very well repossess their property after maybe giving a couple of months payment holiday. With our product, if the customer can't afford to pay the £1,000, that's absolutely fine, because part of that target payment is equity purchase, which is optional. So they can choose to just pay rent, which is a lower amount, which eases the burden slightly in those months. Now, let's say, God forbid, the customer loses their job and they can't even afford to pay the rent. Well, with our product, the customer has tangible equity in their home. These are tangible shares in their hands. And so they can actually trade those shares with us. So rather than paying us £500 or £600 rent in the month, whatever it may be, they can actually give us £500 or £600 of shares in that month instead. And that actually covers their obligation. Even if they don't have cash, they can pay us with shares. That covers their obligation. They aren't considered to be in default. And that gives a huge level of security to our customers, by the way. So to put that into perspective, with a conventional bank or an Islamic bank, if you can't make your monthly payment, you might get 2 months payment holiday before the bank repossesses your property. With us, let's say an average customer, our initial equity requirement is 20%, but let's say it was 10%. An average customer with 10% initial equity, if they lose their job on day one without ever having made a payment, and they have to rely on what we call the equity buffer from day one, that equity buffer for the average customer would give them around 2 to 4 years of security, and that's if they lost their job on day one. More realistically, if it's down the line when they've been purchasing more and more equity over time, then it may give them even more buffer. So our equity buffer notion actually gives a huge amount of security to our customers in a way that you simply don't see on any financial agreement. Now, what happens if primary finance falls into bad times? Well, as I mentioned, each of our customers gets a lease over their property. So even if primary finance was facing difficulties, let's say in the extreme case, administrators came in and started winding us up, the assets they don't actually belong to primary finance. They belong to the customers and the investors. And I'll talk about our investment scheme a bit later on. The assets actually belong to our customers and the investors and the vehicle that's set up for those entities. And so what that means is any administrators or liquidators of primary finance would have absolutely no right to repossess those properties or fire sale them or anything like that, because they aren't actually assets owned by primary finance. They are assets owned by the customers and the investors. And so our customers would be protected because they would still be the leaseholder of the property, and a leasehold title is a form of property ownership. So they would still be the leaseholder, and the liquidators of primary finance would not be able to sell off those assets.
Understood. And I guess not to get too technical, but I'm just kind of thinking through. So what would the liquidators be? Be trying to what assets would they be looking at? They'd be looking at presumably the freehold, and I'm just trying to think about it from a homeowner's perspective. How would it affect them? In other words.
Yeah. So just to make this clear, so we have primary finance, which is me, Raza, and another director. Primary finance doesn't take investments into primary finance, and it doesn't own any of those homes. We've set up another vehicle in which the customers have shares and the investors have shares, and that vehicle that company owns the properties as well. Okay, so if primary finance runs into difficulty, if we don't have enough money to pay our salaries or our costs, and we have to wind up, that entity will be protected from a liquidation of primary finance. I think that's what Raza was saying. So the freehold of those properties is held by that vehicle, and the customers and investors own the shares in that vehicle. So effectively, customers are owners of their own properties through the company.
So primary finance just has a 1 penny share in that entity. That allows us to manage it on behalf of our customers and investors. But the economic ownership of that vehicle and all of the underlying properties actually belongs to our customers and investors.
Great. Okay. And I'm just conscious of the time, and I'm keen to get into the audience questions. I know a bunch of people have asked about waiting list, lead times, and that side of things. It'd be great to get a sense of how you think about that as well.
Yeah, so we are relatively small at the moment, as you're aware, but we are growing rapidly. We have a public waiting list, which anybody can sign up to from our website for free. Now, the public waiting list is extremely long, and what we're doing at the moment is we have an investment opportunity where we invite members of the public to invest with us, and anybody who's investing with us, we are serving them ahead of the public waiting list at the moment. So as a result of that, the public waiting list, we estimate, is going to take us several years to start serving people on the public waiting list. The reason being that we're serving every single person who invests with us first. Now, the way the investment opportunity works is the idea is that if you've got funds sitting idle, which you may be saving up for a deposit, that money sitting in a bank account is losing value due to inflation. It's perhaps being used by your bank for interest-based transactions, interest-based lending. And because it's sitting idle, as Muslims, we have to pay 2.5% zakat on that every single year. And zakat is incredibly important and incredibly, a wonderful, wonderful thing. But if you're saving up for a deposit and you're giving away 2.5% every year, it makes it harder to save up. And so what we do is we say, right, well, rather than leaving it in a bank account, you can invest it with us. We use it in exactly the same way as your bank. So we use it to finance people's homes, but in a halal way, free from debt, free from riba. We give you a halal profit rate on that capital, and you no longer have to pay zakat on that capital because it's going into property. And that means automatically you can save up quicker for your deposit. And at the same time, because you've invested with us, our way of saying thank you is we move you up our waiting list. And so we aim to serve you ahead of the public waiting list. And depending on the amount and timing of investment, we move people further up the waiting list, and we aim to serve them much, much quicker. So that's how we order our waiting list. And there's sort of information on our YouTube and website further around that. It's also, just before we get into the live Q&A, just worth touching on. So we've sort of explained how we compare to a mortgage product. It's also worth just touching on how we compare to other shared ownership products and what makes us truly unique. So compared to mortgages, we're a completely debt-free product, a completely risk-sharing product, and a completely cost-sharing product, which you don't get on any mortgage product, whether it be a conventional mortgage or an Islamic bank mortgage. Compared to shared ownership providers, the key fundamental difference is our pricing point. So we as I've mentioned, we offer hugely discounted rent, and we sell equity at cost price rather than market price. But on top of that, when you compare to other shared ownership providers, so other shared ownership providers may limit how much equity you can purchase in any given year. We don't limit you. You can purchase as much equity as you like whenever you like. And other shared ownership providers may limit how much equity you can purchase in total. And again, we don't limit you. You can purchase all the way up to 100% with us. So you don't have to get to a certain point and then take on another finance arrangement. You can go all the way up to 100% with us. And so whichever way you compare it, we've basically taken we've created a product which effectively gives you the best of both worlds. You get the best of the mortgage world because you get the pricing point that's akin to an Islamic bank mortgage, or very, very competitive against an Islamic bank mortgage. But you also get the risk sharing, cost sharing nature of a shared ownership product. So you actually get the best of both worlds with our product. And I think that's really worth highlighting.
Can I just add to that? So me being a lawyer, I like to read contracts. So I've got hold of some of the shared ownership contracts that are out there from friends who've gone out and got those because they wanted to avoid sort of both the traditional conventional mortgages and Islamic mortgages. And I was actually quite shocked to find what I found in some of these shared ownership contracts. And it's really important because, as you know, as a lawyer, the devil's in the detail. It's what's written. It's the words that will count.
Without naming names.
Without naming names. So one of these contracts has a clause which allows, and I actually caught up with that friend. He's several years now into that shared ownership contract. So he has 20% equity in his property, but the shared ownership provider is allowed to review his rent every year and just mark it up. So now he's at a point where even though he's got 20% equity in his property, very soon he's going to be paying the full market rent as though he had no equity. So and then soon after that, it's going to go above the market rent. So he'd be better off selling that property, cashing in his 20% equity and just renting on the market because it's not giving him any benefit. So it's really important to look at the shared ownership contracts and see. And in a sense, you might say, well, it is Sharia compliant, but it's punitive. It's punishing you for being a Muslim. And that's the problem we came here to solve.
Yeah, just to clarify on that. So with our product, we do review rent every year, but your rent can go up or down. It moves in line with the local property market. So we can't just put it up every single year regardless of what's happening. It goes up or down based on the local property market. And it's capped as well. So it can never. So actually, the average customer, their total payments should never ever move by more than 1 or 2% total in any given year. So we offer a level of stability there, even though we are reviewing it.
Brilliant. Okay. And then one final question I had before we turn to the audience's question. And by the way, I know there's a lot of questions and a lot of people have tuned in. So really appreciate that. Please do share it with your friends and family. Now is a good time to get these guys, busy as they are, to answer your questions. Fun fact: I live near Sheikh Salman, and I'm not going to tell you where I live, but I often see him in the Tesco. So if you just lurk around that particular Tesco, then you could get lucky sometime. So Sheikh Salman's going to start wearing the mask now, even inside Tesco. So you better wear a mask as well. Yeah, I know. I probably should. So final question: SDLT. What's the situation there?
Yeah, so the way it works is, as I mentioned, when the property is purchased, it's purchased by this vehicle that we mentioned. So this vehicle is set up to purchase the properties. Now, when we purchase it through the vehicle, we pay the stamp duty at that point in time, not the customer. So because the vehicle is purchasing it, the vehicle pays the stamp duty at that point in time. We then factor that into the acquisition cost of the property. So as I mentioned, if it's a £100,000 property and we pay £5,000 stamp duty on it, we will then, 20 or 30 years down the line, when you want to fully purchase the property off us, we will sell it to you for £105,000 at that point in time, regardless of the fact that the property may be worth £500,000. So we factor it into the acquisition cost. Now, there's actually 2 or 3 really key benefits to this approach. So the first obvious one is when you buy a property through a bank or indeed an Islamic bank, you have to pay the stamp duty up front out of your pocket, and that's a very hefty sum of money. Whereas you don't have to do that with us because we cover that out of the funds provided by investors. Secondly, what it means is if you're a first-time buyer, you get to preserve your first-time buyer's relief until 20 or 30 years down the line when you're actually buying the property from us. And by that point, if you're lucky, the thresholds for stamp duty may have crept up, and they do creep up over time as house prices increase in order to remain meaningful. So it may be that in 20 or 30 years' time, you actually make a stamp duty saving, because that's the point at which you actually pay your stamp duty on the property if the thresholds have crept up. So because you're paying the same price as if it was in today's money, you could actually make a saving. And thirdly, and this is a really big one, when you buy a property through a mortgage or an Islamic bank mortgage, you pay your stamp duty, you use up your first-time buyer's relief, and now any subsequent properties you purchase are at the full rate. And statistically, it's very, very unlikely that the first property you buy will be the property that you live in for the rest of your life. Very, very unlikely. So you use up your first-time relief on your first property purchase. With us, because the property is purchased through this wrapper, through this vehicle that we mentioned that's owned by you and the other investors, you don't use up your first-time buyer's relief. So that means partway through the agreement, if you decide you want to sell the property and buy a different property, you still don't use up your first-time buyer's relief. So you can actually preserve your first-time buyer's relief, even if you go through 5 or 10 properties, right until your forever home when you actually purchase it from us, from the vehicle. That's the point at which you use up your first-time buyer's relief. So you can protect your first-time buyer's relief all the way through that process, regardless of how many properties you purchase. So some really key benefits to that approach.
Brilliant. Sounds great to me. Okay, so in terms of action points, so I've shared the link. What I'll do is I'll actually share a banner as well, so you guys can see it. But what should an investor do, and what should what should a homeowner do, or someone who wants to purchase a home? What's the best thing? I mean, I think you're going to say it's the same thing, right? But what is it? What's that thing?
Yeah, so there's certainly a large degree of overlap between our investors and our customers. The reason being that most of our investors ultimately want to buy a home with us. And actually, any money that's invested with us, because of this structure that we've set up, that investment, those invested funds automatically become your initial equity in your own home purchase with us when your turn comes up. So the idea is, rather than your money sitting, rotting and depreciating in a bank, you're putting it to some good. You're helping other people avoid riba and debt while you're waiting. You're growing your own deposit while you're waiting, and your turn is coming quicker. When your turn comes, that money that you've invested is your own initial equity in your own home purchase. And so most people who invest with us actually ultimately want to become customers as well. So what I'd say, anybody who does want to become a customer, it's worth considering our investment opportunity, because that's a way of fast tracking and getting boosted way up the waiting list compared to joining the public waiting list. The public waiting list is there, it's free, it's open to anybody who wants to sign up. But as I mentioned, we're serving anybody who invests with us ahead of the public waiting list. And we want to serve every single one of those before we move on to the public waiting list, inshallah. So the investment opportunity is on our website. We've also got a very good YouTube channel where we go through the key reasons to consider the investment opportunity, how we structure it, how we look after your money, all that kind of stuff. So it's worth having a look on our YouTube channel as well. And we as a team are very, very approachable as well. We pride ourselves on responding to inquiries within a very timely time frame. So particularly email inquiries, we try and respond to them typically within a day or two. And so if people have specific questions, if they're not sure about anything, send them through via email, info@primary-finance.com. That's the best email address. If you mention my name, I'll respond to you personally. I pride myself on responding personally to these inquiries. And then, if you want a call back, we can arrange a call back, but it typically takes a bit longer. Emails are generally the best way of getting questions answered. But if you do want to go ahead with the investment opportunity, we open our investment window every 3 months. The next one's opening on 1st of October, inshallah, and then every 3 months from that point. And so you can just register your interest from our website. When the investment window opens, we'll send you the next steps, how to complete your investment, and then you'll get onto that prioritized waiting list as well, inshallah.
Fantastic. Okay, so now we are into the Q&As. There's been a lot of questions. Let me just skip. Is there a product fee? I guess we've kind of covered that already, right? Your investment will then become your deposit. Okay, so Umar is active on the chat as well, nipping some in the bud. What are the chances of collaboration between primary finance and yielders? I'm happy for you to defer that question if it's.
Well, we've actually already collaborated with yielders in the past,
okay.
Believe it or not. So, the management team there, we know them well. There's obviously been some changes recently, but we've collaborated with them in the past, and it went really, really well, mashallah. And we'd certainly be open to further collaborations in the future.
I've just realized my son's stickers are showing on the back of my laptop. I can assure you, it's not my taste in stickers. Pink dragons is not what I'm interested in. Anyway, what about building insurance? What's the situation there? Should I turn to you or?
Yes. So we do require our customers to take out insurance. Now, there's several choices that they have when they go out to the market, and I've actually done a bit of research on the insurance that's available out there. In fact, I was recently approached by an Islamic charity that wanted to take out some insurance for their employees, a health insurance, and they introduced me to the company that was providing, which was a mutual, or the mutuals or cooperatives. There's a whole sort of range of insurance products out there that are provided by mutuals and cooperatives. And I actually spoke to the people at the highest level, the financial officers in the mutual, and I did a sort of analysis of the contract, and I came to the conclusion that this contract is actually Sharia compliant. And so what we want to do is encourage our customers to go out there and try and find mutual insurance providers that provide home insurance on a mutual basis, so that they can be happy that the contract that they're entering into is Sharia compliant. Inshallah. Razad, would you like to add to that?
Yeah, just to add to that. So, there are differences of opinion on what's halal and what's not when it comes to insurance. So, there is an opinion that all insurance is halal, and I know, Ibrahim, that's the opinion you subscribe to. There's, another opinion, as Sheikh Salman just mentioned, that cooperative and mutual insurance companies are halal. And effectively, cooperative and mutual insurance, when done properly, are effectively the same as Islamic insurance. They're effectively no different whatsoever. And then the strictest opinion is that, no insurance company in this country is halal at the moment. But even there, where there's a will, there's a way. If you're willing to pay enough money for it and do enough work, you can get something structured if you really want to. The point is, we don't prescribe the insurance company that our customers must take their insurance from. So we allow our customers to determine what opinion they follow and what they feel comfortable with, and we allow our customers to take insurance wherever they feel comfortable.
Sorry, I might have missed this, but do they have to take insurance or no?
Yes, it's a
They have
requirement.
to. Okay. So M. Aminur Rahman is asking about. I think the question is. He's asking the question. I think is, what's the maximum and minimum amounts that is relevant for primary finance?
So in terms of finance,
yeah. So here he's saying, like, would you give me 20,000? I've got 80,000. Would you just give me the 20,000? And then other people have asked, well, what's the maximum that you would give, let's say, for London?
Yeah. So this is obviously a moving target, and people watching this recording should seek to get the most up-to-date information. But at the time of recording, the minimum amount is £50,000, and the minimum property value that we support is £100,000. The maximum property value we support at the moment is £500,000, and the maximum we contribute towards that at the moment is £350,000. Now, as I mentioned, we're growing very rapidly at the moment, and those figures there have actually grown substantially even since the start of the year when we started trading, and we hope to continue as we grow and scale. We hope to continue being able to push those out, but those are the figures as at the time of recording.
Understood. So I guess this question, the answer to that would be that it's a moving target, but it's roughly around the 30% mark at the moment. It's at the higher end of the spectrum.
Well,
let's say you go for £500,000.
Yeah, so somebody looking for a £500,000 property would need to contribute £150,000 themselves, because the maximum we contribute is £350,000. But subject to that cap of £350,000, the initial equity requirement is 20%. So if somebody wanted to buy a £250,000 property, they would only need to contribute £50,000, and we would contribute the remaining £200,000.
Right, I see. Okay. How easy is it to transfer an existing mortgage, and what is the process?
Yeah, so at the moment, we're working on a new product, which we're inshallah launching early next year, which will allow us to actually cater for the refinancing market as well. So people on existing mortgages who want to transfer over, inshallah, we're launching a new product that will allow that. So watch this space.
Brilliant. Very excited to see that go live. Would you accept 10 to 20% initially for a property that is 250k? You've already answered that. Minimum property price, we've already discussed that. Assalamu alaikum. My question is, when are you going to support investors in London, as you don't lend enough for one to be able to buy anything decent? Habib is not messing around.
Is this Habib Chanawala? Okay, I know Habib very well, mashallah.
We're gonna hunt you down after this, Habib.
Habib, you like putting me on the spot, don't you? Yeah. So I mean, it just comes down to a question of scale. At the end of the day, yes, prices in London are much higher, and £500,000 property price goes much less far in London than it does up north in Manchester. We are working hard to push up the total property value we can support and the total amount we can contribute towards that. Inshallah, we hope to increase the figures I just mentioned around the middle of next year. And we hope to continue pushing them outwards. And we're very, very conscious that there's people living in London. Actually, you know, it's worth mentioning that we've already financed several properties in Greater London, maybe not Central London, but within the Greater London region, we've already financed several properties. So it is certainly achievable. But where you're looking for, you know, the £600,000, £700,000, £800,000 properties, we just need to grow a bit more and make sure that we're managing our risk appropriately.
Omar Patel is asking, will the main priority in waiting list be given to residential borrowing compared to buy-to-let borrowing? And what's broader the situation on buy-to-let?
Yeah, so we do offer buy-to-let finance, but it's the same unified waiting list. So the way we order our waiting list, as I mentioned, is based on the amount of support we're getting effectively. If somebody's supporting us, we want to support them back. So when their turn arises, if they want a buy-to-let property, we're not going to say no, even though our main focus is on the home provision scheme, because that's where we feel the need is greatest, where people need this product the most. Ultimately, we want to support those people who are supporting us first and foremost. And so if somebody wants a buy-to-let product, we'll be very happy to support that, inshallah.
Makes sense. And from a commercial perspective, I guess it reduces I'm just trying to think through if it's commercially worth it for people to go for a buy-to-let. I don't know what's the experience you guys have had, the kinds of people that do go for the buy-to-let.
Yeah, so out of all the properties we financed to date, probably approaching half of those are buy-to-let. And I think if you understand the ins and outs of the product, you understand the benefits of the product, then the pricing is very, very good for what you're getting. As I've mentioned, you're getting a shared ownership type product for a significant discount to what any other shared ownership provider will charge you. So as long as you understand that that's what you're getting, the pricing is well worth it. If I like to give an example here. If price is most important to you over other aspects, then that's fine. That's absolutely valid. But the example I like to give is, imagine if you go to a supermarket and you're in the mood for a smoothie, right? And you want to buy a smoothie. Now, you go to the drinks aisle and you see a Coke for 30p and you see a smoothie for £2, right? You know the Coke has cheaper ingredients and it's not very good for you. And you know the smoothie has pure ingredients and it's very good for you. So you won't go to the cashier and say, well, this smoothie should cost the same as this Coke. It doesn't make any sense. It's a completely different product and it has various health benefits. Similarly with organic food. You can't possibly expect organic food to cost the same as, battery farm chicken or whatever. It just doesn't work that way. So similarly with our product, you can't compare it to the cost of a debt-based mortgage. It just doesn't make any sense. Even though we've driven down the price as far as we can possibly drive it down while still maintaining a viable business model, the point is there's no point in comparing our pricing to a conventional mortgage. If the price is the only thing that matters, then fine, by all means, go for a conventional mortgage. But if what matters to you is getting a product where you will not be in debt for your entire agreement term, you will never come anywhere near riba, you will have true risk sharing and true cost saving, and you know that in times of difficulty, our product caters to that and makes life easy for you, rather than us coming along like a bank might do and kicking you out of your home when you're already going through the hardest time of your life. If those things are what matter to you, then paying for that is a no-brainer. It doesn't make any sense to assume it would cost less.
Just conscious of the time, I think we'll take two more questions, including this one. If not FCA regulated, how is the money equity protected?
Yeah, so we've got a really good YouTube video on this. I'd encourage people to go onto our YouTube channel and sort of watch a video that we've done specifically on this point. I am conscious that we're running out of time, so rather than trying to go through it in detail now, we've touched upon it already. The money that you invest with us, it doesn't go into primary finance. It goes into a separate entity that's owned by you and the other investors directly. So it's ring-fenced away from the wider risks of primary finance.
Fantastic. Some nice comments. They're worrying about when you will be getting to London. Is there a minimum investment amount? That's a good question.
Yeah, so at the moment,
We have financed properties in London already.
yeah. So we are financing properties in London. It's just the high end of the London
Yeah.
market that we can't
Yeah.
currently support. The minimum investment amount currently is £5,000. And the way it works is as you can top that up over time. And as you top it up, you move further up the waiting list. And as you approach, the current threshold is £30,000. Then we add you to what's called the priority waiting list. At this point, you have a realistic chance of becoming a customer because you have to have 20% minimum initial equity to be a customer. So once you reach that £30,000 threshold, then we add you to our priority waiting list, which has the shortest turnaround times, and we do everything we can to serve you as quickly as possible after that point. But you don't have to invest it all at once. You can gradually top up over time.
Fantastic.
And by the way, that minimum £5,000, again, anyone watching this recording, do get in touch for the latest information because that may be coming down.
Incredible. Guys, we better wrap up because Maghrib is fast approaching. And I would like to thank Sheikh Salman and Raza from Primary Finance for making the
Thank
time.
you for having us.
It's been really, really interesting. I've actually really enjoyed this. And inshallah, maybe we'll have you back in due course in other webinars, episodes, and all sorts of things in the future, inshallah.
Inshallah, it'd be our pleasure.
Until next time, Assalamu alaikum.
Assalamu alaikum.